Let me start with a question that might sound strange at first. Can you have two life insurance policies? The answer is yes, absolutely. In fact, having just one policy might be the reason your family is underinsured. But here is the number that will surprise you. Nearly 40% of people who buy life insurance stop there. They buy one policy and think they are done. They are wrong. The smartest financial minds in the world do not have one life insurance policy. They have two, three, sometimes four. And they do it for reasons that have nothing to do with being paranoid and everything to do with being strategic. By the end of this video, you will understand exactly why you should consider having multiple life insurance policies, the three specific scenarios where two policies are better than one, and how to structure them to save money and maximize flexibility. I will break down the concept of laddering, the hidden value of convertible term policies, and the tax advantages of having both term and permanent coverage. Whether you are a young professional, a parent, or a business owner, this strategy could save you thousands of dollars and give you peace of mind for decades. Let me start with the most common objection. People think having two life insurance policies means paying two sets of fees, two premiums, and twice the hassle. That is not true. In fact, buying two smaller policies can often be cheaper than buying one large policy. Why? Because of how insurance companies price risk. A 20-year term policy is cheaper than a 30-year term policy. A 10-year term policy is cheaper than a 20-year term policy. If you need coverage for 30 years, you could buy one 30-year policy, or you could buy a 20-year policy and a 10-year policy. The combined cost might be lower because the 10-year portion is very cheap. That is called laddering, and it is one of the most powerful strategies in life insurance. Now, here is the pattern interrupt that most people do not know. Laddering is not just about saving money. It is about matching your coverage to your changing needs. When you are 30 years old, you might need $1 million of coverage. Your mortgage is large. Your children are young. Your income is growing. At age 50, your mortgage is smaller. Your children are grown. You might only need $500,000. If you buy one 30-year level term policy for $1 million, you are overpaying in the later years. You are paying for coverage you do not need. Instead, you can buy a 20-year term policy for $500,000 and a 30-year term policy for $500,000. The 20-year policy expires when you are 50, exactly when your need decreases. The 30-year policy continues until you are 60. You pay less overall, and you have the right amount of coverage at the right time. Let me give you a real-world example. A 30-year-old non-smoking male in good health wants $1 million of coverage for 30 years. A single 30-year level term policy might cost about $750 per year. A laddered approach. A 20-year term policy for $500,000, costing about $250 per year, and a 30-year term policy for $500,000, costing about $400 per year. Total annual premium is $650. That is $100 less per year, or $3,000 less over 30 years. And the coverage matches his decreasing need. That is not a small saving, that is a vacation. Now let me talk about the second reason to have two policies: flexibility. Term life insurance is great because it is cheap. But what happens when your term ends? If you are still healthy, you can buy a new policy. But if your health has declined, you may not qualify. That is where a small permanent policy comes in. You can buy a small whole life or universal life policy that lasts your entire life. It will be more expensive per dollar of coverage, but you only need a small amount. For example, You could buy a $250,000 30-year term policy for most of your coverage, and a $50,000 whole life policy that lasts forever. The whole life policy guarantees that no matter what happens to your health, you will always have at least some coverage. It can also build cash value that you can borrow against in retirement. This combination gives you the best of both worlds: low cost for most of your coverage and permanent protection for your final expenses. The third reason to have two policies is for business owners. If you own a business with a partner, you likely need life insurance for a buy-sell agreement. That coverage is tied to the business. It should be separate from your personal life insurance. If you mix them, you create a mess for your family and your business partner. Buy a separate policy for the business. Keep your personal policy for your family. That way, if you die, the business policy pays your partner so they can buy your shares. The personal policy pays your family so they can pay the mortgage and send the kids to college. Two policies, two purposes, no confusion. Now let me give you a step-by-step guide to building your own multi-policy strategy. Step 1. Calculate your total coverage need. Include your mortgage, your children's college, 10 years of income replacement, and final expenses. This is your total target. Step 2. Break your need into time buckets. How much coverage do you need for the next 10 years? For the next 20 years? For the next 30 years? For life? Your youngest child's college fund might be a 20-year need. Your mortgage might be a 15-year need. Your final expenses are a lifetime need. Step 3. Buy a term policy for each bucket. Use the laddering technique, a 10-year term for your mortgage, a 20-year term for your children's education, a 30-year term for income replacement until retirement, a small permanent policy for final expenses. Step 4. If you have a business, buy a separate policy for the business. Keep it in the business's name. Step 5. Review your policies if your needs change. You may need to add a policy, reduce a policy, or let one expire. Now let me address the concerns about managing multiple policies. It is not hard. You can keep all your policies with the same company for simplicity. You can also use a spreadsheet or a password manager to track policy numbers, coverage amounts, and beneficiary designations. You only need to pay attention once a year when premiums are due. The extra few minutes of organization is worth the thousands of dollars you save. What about the UK and Canada? The same principles apply. Laddering works in all three countries. In the UK, you can buy multiple term policies from different providers. The tax treatment is similar. In Canada, you can also ladder term policies. The permanent insurance options vary by province, but the strategy is the same. Use a small permanent policy for final expenses and a larger term policy for temporary needs. Let me give you a real-world example of a family that used multiple policies correctly. A couple in their 30s with two young children had a $300,000 mortgage, two children who would need college in 15 and 18 years, and a desire to replace the higher earner's income for 10 years. They bought a 15-year term policy for $300,000 to cover the mortgage. They bought an 18-year term policy for $200,000 to cover college for the younger child. They bought a 10-year term policy for $500,000 to replace income. And they bought a $50,000 whole life policy for final expenses. Their total annual premium was about $650. If they had bought one 30-year term policy for $1 million, their premium would have been about $750, and they would have been overinsured in the later years. By laddering, they saved $100 per year and had coverage that matched their exact needs. Now, let me talk about a mistake to avoid. Do not buy multiple policies from the same company without shopping around. Different companies have different strengths. One company might have the cheapest 10-year term. Another might have the cheapest 30-year term. A third might have the best whole life product. Shop each policy separately. You can mix and match. There is no rule that says all your policies must be from the same insurer. Another mistake is forgetting to update your beneficiaries. If you have multiple policies, each one has its own beneficiary designation. Make sure they are consistent. If you want everything to go to your spouse, make sure all policies list your spouse. If you want a specific policy to go to your business partner, list them on that policy only. Keep a master list and review it every year. Let me also address the question of overinsurance. Can you have too much life insurance? Yes, but the threshold is very high. Insurance companies will limit your total coverage based on your income. Typically, you can get coverage up to 20 to 30 times your annual income. Beyond that, you would need to justify the need, such as a large estate tax liability or a business loan. For most families, having $1 to $2 million of coverage is not too much. It is often not enough. Now let me give you the bottom line. Having 2 life insurance policies is not only allowed, it is often the smartest way to buy coverage. Laddering saves you money. Combining term and permanent gives you flexibility. Separating business and personal coverage protects your family and your partner. The extra effort is minimal. The savings can be thousands of dollars. Here is what I want you to do right now. If you have a life insurance policy, pull it out. Look at the term length and the coverage amount. Ask yourself if your needs today are the same as they were when you bought the policy. If not, consider adding a second policy to fill the gaps. And if you are shopping for a new policy, do not just buy one. Build a ladder. Match your coverage to your timeline. You will sleep better, knowing you are not overpaying and not underinsured. Let me recap the key takeaways. Number 1, you can absolutely have 2 or more life insurance policies. There is no legal limit. Number 2, laddering. Buying multiple term policies of different lengths can save you money and match your coverage to your changing needs. Number 3, combining a small permanent policy with a larger term policy gives you lifelong protection for final expenses at a low cost. Number 4, business owners should keep business life insurance separate from personal life insurance to avoid